Hello, class, and today we are going to be talking about Chapter 3, the Cost Volume Profit Analysis. Some of the class objectives for this particular section is perform cost volume analysis for a single product, perform volume profit analysis for multiple products, and then the last thing we're going to be talking about is to discuss the effect of the operating leverage. So let's get started. Now, what is cost volume profit analysis? Well, if you look in your book on page 67, the definition is managers use cost volume profit analysis to study the behavior of a relationship among these elements as changes occur in the number of units sold, the selling price, the variable cost per unit, or the fixed cost of a product. And so, what we're going to be talking about today is basically we're going to be talking about the revenue per unit. We're going to talk about variable costs, fixed costs, and a number of units sold. We're going to be talking about learning how to figure out the break even, and then talk about some other target operating income and items like that. So, why do we perform the cost value profit volume profit analysis? Uh, it is very useful for numerous situations to evaluate anticipated results from strategic decisions. Decisions such as whether to increase advertising, reduce the selling price can be facilitated with a CVP analysis. In the book, you'll see that there is a very good example about this where Emma has decided to sell a study material. And throughout the chapter, they present different scenarios with regards to her decision whether to do the um, the event in Chicago or to not to do it, what type of charges that she should charge, and of course dealing with advertisement. Now, uh, contribution margin. One of the things that we need to talk about is what is the contribution margin per unit. And basically, it is what is left over to cover fixed costs and then added to operating profit. So, how do we figure that out? We take the revenue minus the variable, and that is going to give us the uh, contribution margin per unit. Fixed costs are unaffected by the changes in volume, so they do not affect the contribution margin. Now, how do we figure out the contribution margin per unit? We have the revenue per unit minus the variable cost per unit. Just the plain contribution margin would be the revenue minus all variable costs. Now, we also need to figure out what the contribution margin ratio is, and that will help us in some other calculations later on. So, how do we find that? We take the contribution margin per unit and divide that by the sales price per unit, and that will become a percentage. Remember, the ratio is always going to be a percentage. Okay? So, if you look in your book, you'll find out that Emma had some uh, different, if you look on page 69 in your book, you'll find that Emma had done some evaluation in regards to her revenues, her variable costs, and her contribution margin. Well, the revenues, what she decided she was going to sell these packages for $200 uh, per package. Her variable cost was $120 per package. So if we take the difference between those, it's 200 minus 120, which gives us $80 per package. Now her fixed costs were $2,000. And so if we take that contribution margin of $80 and divide it by 200, then you will find out that we have a contribution margin of 40%. Okay. We also can do that by even the different packages sold. If you look at that chart on the bottom of 69, you'll see that compared to her fixed costs, if she sold no packages, she'd have a $2,000 loss. One package would have 1920. Five packages would be 1600. Her break even is 25 packages, and we'll be talking about that here in a few minutes. And then 40 packages is going to be a profit of $1,200. Now, when I talk about the break even point, what am I talking about? Basically, the sales volume that covers all costs but do not make a profit. And so, what you're finding out there is you're going to take your revenues minus your variable costs, minus your fixed costs, and that's all going to equal zero. What is the minimum you can make or sell to have your no profit, no loss? And that is your break even point. Your target profit determines the sales necessary to generate a certain uh, level of profit. So if you look at our chart down at page 69, you'll see that if she wanted a target income of $1,200, then she would need to sell 40 packages. Now, the safety, the margin, a margin of safety is the amount of by which sales can fall from the current level to the break-even point. So, if we have the current level of $1,200, and then the operating income, or drop it down to the break-even point, so I could have sales anywhere between 25 and 40, and I'd be okay. But anything below 25, I would lose money on. So your margin and safety units would be sales in units minus your break even units. So in this case is 40 minus 25, which is 15. So I could have a range of 15 below 40 and I'd still be okay in making a profit. Your margin of safety percentages is your margin of safety dollars divided by your revenues. We also talk about the income tax, multiple products for the CVP analysis. So let's talk about the first problem that we have. To illustrate the tools that are used, we will look at Memories Incorporated. Memories Incorporated produces and sell gem-crusted gold frames. And they're telling us that each frame is going to sell for a price of $250. The variable costs are for direct materials is $90, direct labor is $10. The variable manufacturing overhead is $7, and the variable sales and advertising is $15 per unit. They go on to tell us that our annual fixed costs are $42,000, our administrative expenses are $56,000, and our manufacturing overhead expense is $30,000. And our current sales level is 2,200 frames. So the first thing we want to do is we want to find what is the CMR of Memories Incorporated. And so how do I find that? That is actually the contribution margin rate. So the first thing I have to do is I have to find the contribution margin. So remember, what was the contribution margin? It is the sales price minus all the variable costs. So in this case, we have 200 minus the sum of all the variable costs. So if I add $90, $10, $7, and $15 together, I'm going to come up with 122. Take that from 250, and so my contribution margin is $128. Now, how do I figure out the contribution margin ratio or rate? I take the 128, divide by the 250, which is my sell price, and so my contribution margin ratio is 51.2%. Now, how do I figure out my break-even point? So remember, what is the formula for break even? It is the sales price minus the variable cost minus the fixed cost, and that has to equal zero. So here's the formula that we set up. 250x. X represents the number of frames I'm going to be selling. And then remember, the sum of all my variable costs was $122. So, but I don't know how many frames I'm going to sell. So again, it's 122x minus the sum of all the fixed costs. And if you look above, you'll find out the fixed costs were 42,000, 56,000, and 30,000. When I add those up, my fixed costs total $128,000. I take the 250 minus the 122, I get 128x minus 128,000. And I set that equal to zero. I add 128 to each side and then divide by 128 and I get 1,000 frames. So that means that I have to sell at least 1,000 frames in order to break even. That means I don't lose any money or I don't gain any money. Now, what is the sales revenue at the break even point? Well, how I figure that is I take the number of units that I am going to sell at the break even point, which is 1,000, multiply it by the rate I'm going to sell it, which is 250. So 250 times 1,000 is $250,000. Now, we go on to talk about if memories want to operating income of $1 million. Now, remember that operating income is actually before taxes. We'll be talking about taxes here in a little bit later on, but right now we're just going to focus on pure profit from revenues, variable expenses, and fixed costs. So, what I do is to use the same formula that I used up in the break even point, but instead of putting zero there, I'm going to put $1 million. So, same formula, 250x minus 122x minus the sum of all the fixed costs, and this time it will equal $1 million. Now, then I take the 250 minus the 122, I get 128x. I add all the fixed costs, I get 128,000, and that all equals 1 million. I add 128,000 to each side, and I divide by 128. Now, in this type of problem, we don't use the normal rounding principles where anything below 5 gets round down, anything above 5 gets round up. If it's anything above, say that I think they believe that if you divide that, it's going to be 8812 point something. If it's point something, you always have to round up because we cannot sell a partial frame. So we have to round up to the next number. So if I take 1.128 million and divide it by 128, I don't quite get 8813, but because I can't sell a partial frame, I have to round it up to 8813. So the answer, if I want to sell or earn $1 million in profit, then I have to sell 8,813 frames. Now, how do I find the break even in this part? The margin of safety. Remember, the margin of safety is the difference between the actual or budgeted sales and the break even point. So what are my current sales dollars? Well, if I take the million, or actually I should take the 22 because they say that the current sales level is 2,200 frames. So if I take the 2,200 and multiply it by 250 and minus the 550, well, 2,200 times 250 is 550,000 minus the 250, and that equals 300,000. So my margin of safety is $300,000. Now, if I take the $300,000 and divide it by the current sales revenue of 550, I get 54%. Actually, it's 54.5%. So that means that my current revenues could drop by 54% and I would still be okay. Now, how does taxes have an effect on our net income? So let's change it up a little bit where instead of having a operating income of $1 million, they want to have a after-tax income of $1 million. And they go on to tell us that our tax rate is 35%. Well, the first thing we have to do is figure out what that after-tax income is. And so we take the target amount that we want, which is $1 million, and divide it by 1 minus the tax rate. So we have $1 million divided by 1 minus 0.35, because remember, anytime when you're dealing with percentages, you have to convert it into a decimal. So I'm going to take 1 million divided by 0.65, because that's 1 minus 0.35. And if I take 1 million divided by 0.65, I get 1,538,462. And so that's what my target income has to be. So if I go back to the original formula that I've been dealing with all this time, I'm going to take the 250 times the number of units I need, minus the 122 minus the times the units I need, minus all the fixed costs, equals 1.538462. Adding like terms, I take the 250 minus 122, that gives me 128. I add all the fixed, which is 128,000, set it equal to 1,538,462. I add 128 to both sides, so I get 128x equals 1,666,462. Divide by 128, and so the number of frames that I have to sell is 13,020. All right. Hopefully, if you have any questions, just let me know. You can email them to me, and I'll be more than happy to answer them. All right. So now let's talk a little bit more about, let's go through another one. And this particular one, you're going to find in the Excel spreadsheet that is in under chapter 3 or week 3. So let's go ahead and pull up the Excel spreadsheet. Now, Lifetime Escapes generates an average of revenue of $5,000 per person on its 5-day package tour. The variable cost per person is going to be as follows. The airfare is $1,400. My hotel accommodations is $1,100. My meals equal $300. My ground transportation is $100. Park tickets and other costs is going to cost me $800. So my total variable cost per person is $3,700. My annual fixed costs are $520,000, and my tax rate is 30%. So the first thing I need to do is I need to calculate the contribution margin per unit and the ratio. Well, remember, what is the contribution margin? Contribution margin is the revenue per unit minus the variable cost per unit. So in the information provided, it says that my revenue per unit is 5,000 and my variable cost per unit is 37. So my contribution margin is $1,300. Now I take that 1,300 and I divide it by the amount of revenue I bring in. So 13 divided by 5,000 is going to be get 26%. So basically what that means is 26% of our 26 cents of every single dollar goes towards my contribution margin. So 26% of my revenues is going to be my contribution margin. All right, now to calculate the break even, again, what is the formula? It's revenues minus variable costs minus fixed cost equals 0. So I'm going to take the 5,000x minus the 5,000x minus 3,700x minus the fixed cost of 520,000, and I'm going to set that equal to 0. Adding like terms, 5,000 minus 37 gives me 1,300 equals 520,000. Divide by both sides by 520,000. Divide both sides by 1,300, I get 400. Now, another way to configure it is taking fixed costs and divide it by the contribution margin per unit. And so that means that I take the 520,000 and divide it by 1,300, and that equals 400, $400 or 400 units. So 400 people I have to sell this to. Now, calculate the revenues needed to earn the target operating income before taxes of $91,000. So what am I going to do? I'm going to set up the same type of formula. I'm going to take the 5,000 minus the 3,700 minus 520 and set that equal to 91,000. So adding like terms, I'm going to take the 1,300 and then I'm going to add the 520 to both sides. So 1,300x equals 611,000. Divide by 1,300, and I'm going to need to bring in 470 packages. Now, the other way you can do is to take your fixed cost plus your targeted profit and divide it by your contribution margin per unit. So that's 520,000 plus 91,000 and divide that by 1,300. And again, I get the same answer of 470 units. Now, to calculate the number of package tours that need to be sold to earn after-tax profit of 91,000. So the first thing I have to do is calculate the before-tax profit. And how do I do that? I take the profit that I want to earn after tax, which is 91,000, and divide it by 1 minus the tax rate. Now, if you go back up to the top and it says the tax rate is 30%, so if I take 1 minus the tax rate, that gives me 0.7. So when I divide 91,000 by 0.7, I get 130,000. So that needs to be my operating income. So again, I plug it into the formula, and after I add like terms, I get 1,300x equals 650,000. Divide each side by 1,300, and I get 500 units. So that means for after-tax purposes, if I want to have a profit of 91,000, I have to sell 500 units. Again, a quick shortcut that you can use is take the fixed cost plus the targeted profit and divide all that by the contribution margin per unit. So I take the 520 plus the 130, add those together, I get 650, divide by 1,300, and I get 500 units. Now, if fixed costs were to increase by 32,000, what decrease in variable cost per person must be achieved to obtain the break-even point calculated in question 2? Well, my break-even point was 400 units. And so now, instead of having X to represent the number of units, X is going to represent the variable cost per unit. So I'm going to take the 5,000 times the 400, get 2 million. I'm going to take the 400, which is my targeted variable or my units. I'm going to take the 400 times the X, and then I'm going to back out the 552, because remember, fixed cost was 520, and if it's increased by 32,000, the new fixed cost is 552. So if I have 2 million minus 400x minus 552,000 equals 0. Add like terms, I get 1,448,000 minus 400x equals 0. And then doing the basic algebra, I end up dividing 1.448 million by 400, and I get 3,620. So in order for my number of break-even units to stay the same at 400, I need to reduce my variable costs down to 3,620. Okay. Again, if you have any questions about this, please do not hesitate to email and ask those questions. So let's go back to our Word document. So now, here we want to perform a cost volume profit analysis on multiple products. So here we have a case where instead of just producing one frame, they want to produce two frames. And so when we do that, we have to take in consideration the price per frame, the variable cost per frame, unit cost, contribution margin, the sales mix. That's the big part of that. And then the package unit contribution margin. So in this case, we're going to have gold frames and silver frames. The price per each for the gold frame, I'm going to sell that for $250. The silver frame, I'm going to be selling that for $126. The variable cost per unit is $122 for gold and $70 for silver. So the contribution margin, if I take the 250 minus 122, I get 128. I take the 126 minus 70, I get 56. Now, the sales mix, what this means is I'm going to be considering this is a bundle, and for every 3 gold frames, I sell 1 silver frame. So if I take the 3 times the 128, I get $384 as my contribution margin for the gold frame. If I take 1 times 56, I get $56. Add that together to my total package, which contains 3 gold and 1 silver. That means that I'm going to have a contribution margin of $440. Now, then we attach this, or we refer this back to the same type of formula that we've had before. So here it does say that our fixed costs are $149,600. So again, remember the revenues minus the variable cost minus the fixed cost equals 0. And that's what I want to see what my break-even point is. So then I'm going to take the contribution margin, because remember, revenue minus variable cost is contribution margin. So I'm going to take the contribution margin minus the fixed cost equals 0. And so remember from up here, the contribution margin for the package is 440. So I'm going to take 440U, which is the number of packages, minus the 149,600, set that equal to 0. Do my algebraic calculations, and I get 149,600 divided by 440. So that means I need to sell 340 packages. So how many total frames is that? Well, then we got to refer back to the sales mix. Each package contains 3 gold frames and 1 silver frame. So I'm going to take the 340 times 3, I get 1,020 frames. And for silver frames, I take the 340 times 1, I'm going to sell 340 silver frames. So now, what is the break-even point in sales dollars? I'm going to take the 1020 times the 250, which is my unit price for the gold, and I come up with $255,000. Then I take the 340 times the 126, which is my sale price for the silver frames. I get 42,840. I add those two numbers together, I get $297,840. Now, in this particular problem, I know the Excel spreadsheet has some information about coffee mugs, and unfortunately, I could not find all the information with regards to that. The information that they provide us is a little sketchy. It doesn't have all the information. And unfortunately, in this particular book that we have, this particular notes was made based on a prior book, which I do not have. And so question number 328 is not the same problem as in the old book. So I do not have that information. So unfortunately, I'm not going to be able to go over that. Now let's talk a little bit about operating leverage. Cost structure is the portion of fixed and variable costs to total costs. An organization's cost structure has significant effect on the sensitivity of its profits to change to charges and volume. Fixed costs remain the same in total regardless of the activity level. So remember, fixed costs, no matter how many items that we sell, that it's going to stay the same. So if you look at the example in the book, her fixed costs are $2,000. So no matter what she does, she has that cost. So even if she doesn't sell one GRE package, she still will have to pay $2,000 out of pocket. This means that even if there's no activity, as I said, fixed costs remain the same. Variable costs, of course, will vary by the activity level. So based on like the example in the book, the number of packages will drive how much her variable costs are. The operating leverage describes the extent to which an organization's cost structure is made up of fixed costs, those costs that do not change whenever the level of activity changes. So the higher the fixed cost in relation to variable costs, the higher the operating leverage. So the degree of operating leverage, how do you figure that? You take the contribution margin divided by the operating income. So let's take a look at this particular problem that they gave us. So given the percentage increase or decrease in sales will result in even larger increase and decreases in profits. So how do I figure this? So we have two firms here, both sell $10 million in sales. Firm one has $5 million in variable costs, whereas firm two has $7 million. The fixed cost for firm one is $3 million, and the fixed cost for firm two is $1 million. So the first thing I want to do is take the contribution margin and divide it by the operating income. So in this case, I'm going to take the 5 million, divide by 2 million. I get 2.5 for firm one. And then I'm going to take the 3 million and divide it by 2 million. I get 1.5 for firm two. Then what I'm going to do is take that 2.5 and multiply it by the percentage of increase. And so how do I do that? I take the 2.5 times 20. So that means there's going to be a 50% increase in profit. So to determine how much the sales would be if there would, or how much the profit would be if there was a 20% increase in sales, I multiply the 50% times the 2 million and I get 3 million. For firm two, I have 1.5 as my degree of operating leverage. Again, I multiply the 1.5 times the 20%. That gives me 30% increase in profit. And so I multiply the 2 million times the 30%. I get $2.6 million in profit. Okay. So as you can see, the higher the fixed cost, the bigger the effect. So let's talk a little bit of practice with the operating leverage. We have LSB Company has the following income statement. Their revenues are 100,000, variable costs are 40, contribution is 100 minus 40 gives me 60, fixed costs are 30, and operating income is 30. Because 60 minus 30 gives me 30. And what is LSB's DOL? And so how do I figure that? I take the contribution margin of 60,000 divided by the operating income of 30,000, and I get that as 2.0. So the answer is B, 2.0. Okay. Now, if LSB's increased by 20,000, if the sales increase by 20,000, what would be the company's operating company? Well, that means if I go from 100,000 to 20,000, that's a 20% increase. Now, how did I do that? I took 100x divided or equal to 120, divide each side, I get 1.2. So that is how I come up with the 20% increase. I take my operating leverage here of 2, multiply it by the 20% increase, I get 40%. Multiply that by the profit, the original profit of 30,000, which is 30,000 times 1.4, which is 100 plus 40%. The new profit is $42,000. So the answer on that one is A. Now, note that the DOL is a two-edged sword. With the increase in revenues, a high DOL accelerates the increase in operating income. However, a decrease in revenues accelerates a decrease in operating income. So works both ways. The higher the DOL, the sharper the increase, but also the sharper the decrease. It also changes as revenue changes. Its value is dependent on the level of sales. Okay. So let's just review a little bit. Understanding the assumptions of limitations of the CVP analysis. It relies on certain assumptions that may limit the applicability of the results for the decision. The limitations are due to the assumptions made, not inherent to the method of the CVP analysis itself. So we're assuming that everything is the same way no matter what. That's the only thing that's going to affect the changes in price is the volume of sales. It is usually assumed that unit variable costs and unit price are constant for all sales units, sales or levels of volume. And a lot of times in business, that is not true. If you have contracts with possibly suppliers that have the higher the items that you purchase from them, a bigger discount you might receive. So, you always have to deal with those step up in discounts and things like that. Simplifying assumptions are easier to deal with, but can be relaxed to incorporate more realistic situations. The more important the decision, the more the manager want to ensure the assumptions are made are suitable. And then the degree of sensitivity of the decisions to the assumptions made dictates caution about the results and the need for considering alternative solutions. So, in a nutshell, that gives you what Chapter 3 is about. There's a lot of calculations. We'll be doing a lot of calculations pretty much the rest of the semester. So, be sure to read the chapter before you do listen to the lectures in the future so that you understand a lot of the things that I'm talking about. So have a great day. The attendance word for this week is the playoffs. You'll soon learn that I am a huge Chicago Cubs fan, and it looks like we are going to make the playoffs this year. So I'm very excited. So a lot of times the attendance word is going to hopefully surround something like that. And of course, football season starts tonight too. So we'll probably get some words associated with that because I'm a huge sports fan. So, anyway, I hope you understood everything that we talked about, or if you don't, please do not hesitate to send me email and ask me questions about it. I'd be more than happy to answer them. Again, always check Blackboard IM to see if I'm online. I'm online throughout the day, off and on, because I work downtown in Indianapolis, Ivy Tech, and so I'm online there. And if not, send me an email, and I am constantly checking my emails, and I'll respond to you and let you know, hey, I can't get to it right now, but I'll get it to it later on. And of course, if you want me to review your homework before you turn it in for a grade, all you need to do is email that file to me, and I will look at it and let you know if there is any issues and what they are. So again, if you have any questions, do not hesitate to ask, and you all have a great week.